Well, there's been a lot of talk lately about a silver number tied to the national debt clock, and some people are treating it like the system just flashed a warning sign in bright red letters. So, in this video, we're going to separate what that number actually means from what it definitely does not mean, and you are going to walk away with a much clearer picture of the debt story, the silver story, and where the real tension may be building. Today is Monday, May 18th in New York. What day and date are you watching from? Drop it in the comments. And if you value this kind of content, support the channel by subscribing and commenting, Our John AG. So, the headline-grabbing number is not a silver spot price. It is not a forecast saying silver is about to trade at some 4-digit level tomorrow morning. It is a ratio. More specifically, it compares the annual increase in a broad measure of dollars in the system with the annual amount of silver mined around the world. That distinction matters a lot, because if somebody sees a giant silver number and assumes it is a direct price target, the conversation starts in the wrong place. Now, here is where this gets interesting. Based on recently published numbers, the United States' total public debt was sitting just under $39 trillion in mid-May. That is not a vague estimate. That is where the official tally stood on the latest available daily reading. And at the same time, long-range budget projections still point to very large deficits ahead, with interest costs doing more and more of the heavy lifting and pushing those deficits higher. So, the debt problem is real. We do not need to exaggerate it to make it serious. We do not need to round it into a bigger number than it is. It is already large enough to matter. And that is really the first thing I want you to notice. The strongest case is usually the cleaner case. When the facts are heavy on their own, adding extra drama only makes the argument easier to dismiss. Now, let's bring silver into this. The debt clock ratio is trying to illustrate a basic contrast. Dollars can expand through the financial system. Silver cannot be created with a keyboard. Silver has to come from mines, recycling, inventories, or existing above-ground stock that someone is willing to release. That is a completely different kind of supply process. One side can change with policy and credit conditions. The other side moves through geology, capital spending, refining, and time. That does not mean the ratio itself is a perfect valuation model. It is not. And this is the counterpoint that gets lost. A ratio that compares money growth with annual mined silver can be useful as a warning light, but it is not a trading screen. It does not tell you the exact price of silver today. It does not tell you the exact price next month. And it certainly does not prove that the market must immediately jump to match the ratio. That leap is too aggressive. However, dismissing the ratio entirely would also be lazy. It is pointing at a pressure that many investors are already watching from other angles. According to the latest publicly available monetary data, broad money was higher in March than it was a year earlier. That does not automatically mean runaway inflation is guaranteed, but it does show that the contractionary phase in money growth is not the whole story anymore. And this is where we need to be careful with language. Some people are calling the Federal Reserve's more recent Treasury bill purchases a new round of quantitative easing. The Fed itself has been explicit that the purchases were reserve management purchases, intended to keep reserves ample and maintain interest rate control, not stimulus-driven QE in the classic crisis-era sense. So, if we want to be precise, we should be precise. Monetary plumbing can matter without pretending every balance sheet operation is the exact same thing. That distinction might sound technical, but it changes the tone of the entire argument. If someone says the money printer is simply back on in the exact same way as the pandemic period, that is not a clean description. If someone says liquidity conditions are becoming more complicated, reserve balances matter again, and broad money is no longer falling the way it once was, that is a much more defensible statement. And frankly, it is still a meaningful statement. Now, a lot of people then jump straight from money growth to inflation and say that inflation comes from one source only. That is also too simple. Inflation can be pushed by money, credit, wages, tariffs, energy, rents, shortages, taxes, expectations, and supply disruptions. In April, energy prices were a major driver of the monthly consumer price increase, while core inflation also remained firm. So, the recent inflation picture is not one clean line with one clean cause. It is a bundle of pressures hitting the same household budget from different directions. There is also an energy layer sitting in the background right now. Recent official energy commentary described serious disruption in Middle Eastern oil flows and modeled a gradual normalization path rather than an instant snapback. That matters because energy costs bleed into transportation, shipping, manufacturing, and consumer inflation psychology. When households feel pressure at the gas pump and businesses feel pressure in freight, the inflation debate gets more emotional very quickly. Silver does not rise simply because oil is elevated, but an unstable inflation backdrop can strengthen the appeal of assets that are not somebody else's promise. This matters for silver because silver sits in two conversations at once. It is a monetary metal in the minds of many investors, but it is also an industrial material. So when people talk about debt, deficits, liquidity, and purchasing power, silver enters the discussion one way. And when people talk about electronics, grid equipment, vehicles, solar demand, and advanced manufacturing, silver enters another way. Those two stories can overlap, but they do not always move at the same speed. From recent market updates, the physical silver market is still being discussed in the context of another annual deficit, but even here the details matter. Forecasts point to investment demand improving, while some categories of industrial demand are expected to soften, particularly where manufacturers continue using less silver per unit in certain applications. That is not bearish spin. That is simply what a real market looks like. Some pieces tighten, some pieces cool. The final balance is what counts. And the mine side is not exploding higher either. Recently published geological figures estimated global silver mine production last year at roughly 26,000 metric tons, only modestly above the prior year. That means supply is not suddenly flooding the market, but it also means we should avoid saying annual mine production is the only supply that exists. Recycling matters. Inventory drawdowns matter. Existing bullion matters. Markets are always more layered than a single headline metric. And on the physical side, it helps to understand what people are actually talking about when they mention serious silver supply. They are not only talking about a few coins sitting in a display case. The institutional market revolves around large, high-purity bars that move through vaults, refiners, dealers, and exchange-linked channels. Retail buyers usually experience silver through smaller products, but those smaller products ultimately trace back to a wholesale system that has its own bottlenecks. Refining capacity, fabrication demand, transport, and the willingness of current holders to part with metal all matter. So when the market feels tight, it does not always mean shelves are empty everywhere. Sometimes it means the system has less slack than investors assumed. This is also why a market can appear calm right up until it suddenly feels less comfortable. Tightness does not always announce itself with one dramatic headline. Sometimes it shows up as wider premiums, delayed sourcing, stronger bidding for available metal, or a growing gap between paper expectations and physical convenience. And that shift can matter very quickly in real time. Now here is one fresh detail that deserves more attention. Recent national accounts commentary noted that silver bars used as investment showed up strongly enough in trade flows that they had to be identified separately in the economic discussion. That does not mean silver is taking over the financial system. Let's not get carried away. But it does tell you, investment-oriented silver movement was not invisible in the data. People were paying attention to physical metal in a very real way. So, when you put the pieces together, the story becomes much better and much more credible. It is not that one debt clock number broke reality. It is that several pressures are lining up at once. The government debt burden remains enormous. Deficits remain large. Interest costs remain a worsening constraint in the official outlook. Broad money is no longer shrinking year over year. Inflation is still uncomfortable. Energy shocks are adding noise to household costs. And silver sits in a market that continues to wrestle with tightness, investment demand, and limited production growth. That does not guarantee a straight line higher for silver. It never does. Real rates matter. The dollar matters. Recession risk matters. If industrial activity weakens hard enough, some demand can cool. If financial conditions tighten, precious metals can get hit even when the longer-term thesis remains intact. We have seen that before. Markets can be right on the big trend and still punish people who assume the path has to be smooth. And that is exactly why I do not like framing silver around miracle numbers. Miracle numbers create impatient investors. They make people think the market owes them a dramatic event on a dramatic schedule. That is not how serious positioning works. A stronger thesis is built around mismatches that take time to resolve. Debt versus revenue, monetary growth versus real purchasing power, industrial dependence versus finite supply, investor interest versus available physical ounces. Those are slower moving forces, but they are also harder to dismiss. There is also a historical layer here that is worth keeping in mind. Silver has moved between two identities for a very long time. At times it has been viewed mainly as money. At other times, it has behaved more like a high beta industrial commodity. In modern markets, it often shifts between those personalities, depending on what investors are worried about. When the focus is growth, silver can trade with manufacturing. When the focus is currency credibility, silver can trade with hard money sentiment. That flexibility is part of what makes it fascinating and frustrating. Now, let's talk about the debt angle one more time, because this is where the entire narrative gets its emotional force. The official long-term outlook does not describe a minor inconvenience. It describes deficits that remain historically large relative to the economy, with federal debt held by the public rising further over the next decade. Again, we do not need to dramatize that beyond the facts. The facts are plenty dramatic. The country is not facing a one-month budgeting hiccup. It is facing a structural imbalance that becomes more difficult when financing costs stay elevated. But here is another skeptical point. High debt by itself does not automatically send silver vertically higher. Japan has carried an enormous debt load for years without producing the exact asset path many people expected. The United States has deeper capital markets, a different reserve currency role, and a different inflation dynamic. So the debt thesis matters, but debt alone is not a timer that tells silver exactly when to move. It is a backdrop, a serious backdrop, not a stopwatch. What can matter more is the interaction. Debt makes policymakers less comfortable with sustained high rates. Inflation keeps rates from falling too casually. Slower growth creates pressure for easier conditions. Energy shocks complicate the picture. And if investors begin to believe purchasing power will keep eroding while real assets remain constrained, metals can benefit from that shift in psychology. Silver often reacts harder than gold because its market is smaller and its demand profile is less pure. That can be a strength on the way up and a weakness on the way down. If you're successful, share your success story in the comments so others can stay motivated. Now, in practical terms, here is the cleanest interpretation. The debt clock ratio should not be treated as a literal silver price target. It should be treated as a symbol of a broader imbalance between expanding financial claims and constrained physical output. The national debt should not be inflated beyond the official reading. It is already massive. The Fed's recent purchases should not be mislabeled if we want credibility. Inflation should not be reduced to one cause, and silver should not be described as a guaranteed escape hatch from every macro problem. But once those exaggerations are removed, the core case does not disappear. It becomes sharper. It becomes harder to knock down. Silver remains connected to monetary anxiety, industrial usage, physical market tightness, and investor interest in hard assets. The deficit backdrop remains unresolved. The debt burden remains high. The monetary picture is not as simple as tight forever. And physical silver demand continues to matter in ways that show up beyond internet speculation. That is why I think the better question is not whether one flashy ratio has already proven a 4-digit silver price. The better way to think about it is whether the world is moving toward conditions that make hard assets more valuable over time. And when you look at debt, deficits, inflation pressure, energy uncertainty, reserve management, broad money, and silver's tight supply picture together, it is not hard to understand why this conversation is getting louder. So, do you think silver's bigger story is monetary protection, industrial necessity, or both? Thank you for watching. Subscribe if you want clear, data-grounded breakdowns without the noise. And one final note, this conversation is for education and perspective, not personal financial advice. Markets can move against any thesis, and every investor has to make decisions that fit their own risk, timeline, and circumstances.